The fact that we just closed at fresh new highs for all the major averages, what do you think of markets at these levels?
Well, let's put it in perspective. We closed at new highs, but we closed at new highs in most years. So right now we're at highs in the absolute level, but we're not highs in terms of a multiple. And when you look at relative, the 10-year at 2.1%, if that's a real rate, if that's the true 10-year rate, multiples should actually be much higher than they are. So I think there's still true bargains in the market, and I think people are they're going to wish they weren't on the sideline, because we've been saying with the market at new highs for 7 years in a row.
What do you mean, Tom, if that's the true rate? I mean, it is the rate. Do you mean if it stays where it is for a prolonged period of time?
I'm glad you clarified. It is the rate, but equity investors are not treating it as though it is. Right now, we've got the 10-year Treasury trading at close to a 50 multiple, and then people are worried about the S&P trading at 17 times. If your earnings yield on stocks is over twice what it is on bonds, then it's hard to be arguing that the market's at too high of a level.
Tom, we've been hearing repeatedly, really for weeks now, that it's been a Fed-fueled rally. But the fact that we do have earnings really kicking off this week in earnest, what happens if we have a recession, an earnings recession, versus the numbers coming in better than expected?
Well, I think people right now, you can see they're pricing in negative earnings. We'll probably get flat earnings for the second quarter. So people are already getting cautious on earnings. And I think the Fed is inducing a rally here. But the other thing you have to look at is, even without the Fed, it's the global marketplace that's driving longer-term rates down. So whatever the Fed does, whether they stay steady or even, which they'll probably lower rates, we're still going to have a 10-year in the low twos, which really kind of adds fuel to the market.